Let's bring in our guest to discuss this. Andrew Tam is CFO at Hong Kong-listed shoe and leather goods maker Stella International, and also with us is CLSA research analyst Chris Gao. We can start off with you this morning, Andrew. A business that's working with very well-known names like Balmain, Moncler, Jimmy Choo, Nike, Under Armour. How are you thinking about this tariff impact?
Yeah, so President-elect Trump was the president in the last administration. So almost 5 years ago, there was a tariff increase then. And actually, most of our customers have actually already adapted and thought for a plan B. What would happen if tariffs further increase? So it's 5 years now. If there's tariffs again at a higher rate, people are pretty well planned. So when we look at a China production, most of our production actually now is all originated for Europe. Okay. The other aspect is actually China for China. So a lot of the brands still look at China as a consumer market. That's still a growing market. So what they have done is transform their production for a speed-to-market, faster-changing demand Chinese market. So that's number one. But two is also a lot of the manufacturers themselves have migrated overseas. We expanded to Vietnam, Bangladesh, Indonesia, also Philippines. Half of production is in Vietnam today, and we've been there for almost 3 decades. And I think this trend of moving some of the production from China to a newer area will continue, I think, over the next few years.
But how much of a margin squeeze is there going to be for the manufacturers, and how inflationary is it going to be on the end price in the United States?
That's a good question, Stephen. So when you think about across manufacturing, I don't imagine any manufacturer earning more than a 20% net margin basis. Okay, so if you have a tariff, anything more than 20%, most manufacturers won't be able to support it. So typically, the tariff is passed through at the end of the day through the supply chain to the end consumer. Because between the X factory cost from a manufacturer to the end retail price, there's almost like 75% margin. Okay, typically 3 or 4x the price. So there's a lot more margin to pass through to absorb on the consumer side of the equation.
It's not just, of course, tariffs that could apply to Chinese-made goods. It's tariffs that are on other countries as well. And the US has made it clear that it wants to close those loopholes. How much are you actually weighing or factoring in tariffs? What's the percentage point that you're working with for your goods?
So, typically I would say tariff with our customers. We'll work with them to basically source in other areas to make sure that we can diversify the production. But really, most of the tariff is really passed on to the customer, which then will ultimately pass on to the consumer. But when you have a scenario where there's tariff around everywhere into China, goods into U.S., it just creates this weird dichotomy where goods are cheaper outside the U.S. and you get a lot of travel purchases for Americans traveling overseas, or logistics will be a big business where things can get around that kind of tariff system.
Let's bring in Chris. You've just been listening to this. What's your first take, essentially, on the impact, not only of the threat of tariffs that we're hearing right now, and that's how the market's responding, and supply chains are adjusting perhaps already, but what's going to be the impact of the increased tariffs?
Okay, thank you, Stephen. So before I answer this question, I would like to take a step back.
Sure.
Regarding this tariff impact. We would like to see how the situation is different versus what it was in the year of 2018, 6 years ago, right? So the first difference is this time the tariff is under a global context, right? So it's not just between China and U.S. It is on all goods imported to U.S. And also there will be some additional tariff between China and U.S. That's the first thing. And the second difference is along with the 6 years development from 2018 to right now, actually China has been seeing lower reliance on the U.S. imports among all the China exports, right? Apparel can be a very good example. And the third thing is actually all of the companies, OEMs, no matter if it's a China company or a global company, has become more resilient, more adaptive over the past 5 to 6 years. So of course, in 2018, we have trade tensions, more notably between US and China. And don't forget, we also have pandemic impact, which caused disruptions in supply chain, in logistics, etc. And the survival requires companies to become more adaptive, to diversify the production base, to make themselves more flexible in terms of everything. Right. So definitely, going back to the direct impact, of course, if there will be additional tariff globally, there will be a rising cost base of all the brand customers, right? And under these circumstances, the brand need to make a very critical balance between market share, between price stabilization, and actually the profitability. Right. So going to the next step is we will need to see if the brand could really just adopt a very straightforward and the easiest way, like the price hike, or they will think of other ways to better mitigate the risk while protect the profitability, while protect the ecosystem of the value chain.
You talked about the global tariffs, and Andrew talked about diversifying places where you manufacture, whether it's Vietnam and elsewhere. But part of the proposals, I guess, is to close the loopholes of third nations of Chinese products going to or being made or shipped, re-exported through other areas. How does that impact then a company like Andrew's, which is diversifying its manufacturing base? You are a Taiwan company, but based in Hong Kong, is that correct?
We're listed in Hong Kong, but most of our operations in over Southeast Asia.
Yeah. So from the current, tariff framework on the table, we can see that basically a 20% global tariff planned for all goods imported to the U.S. While for China, it will be a 60% as a preliminary plan during campaigns of the Donald Trump president elected. Right. So we will see that for China's tariff, it will still be higher than that of global. So actually, diversification of the production base is also very necessary right now. And also in terms of the cost structure, we definitely see the structural trend that diversifying the production base to more cost-efficient locations with actually more labor advantage is also better for the OEMs as well as brand customers in the long run. So this is still a very necessary step. And in terms of the ways to actually better address the balance between price stabilization as well as profitability, of course, brand will think of other ways to do. Firstly, as to optimize the cost structure, brands can actually optimize the product mix, developing more high-margin businesses so the structure can be better. And secondly, of course, enhance the global sourcing capability. All right. And actually, all of these could go first before brands finally decided to maybe pass on some cost to consumers. And this could be a more sustainable way. And all in all, we think that although this could be a challenge globally for the tariff impact, we also think this is a real opportunity to screen out outperformers.
So how are you thinking about this, Andrew, then? Because all of these sort of measures to try and counter the tariffs, they kind of sound expensive. And so they're going to be something that impacts your bottom line. Chris just mentioned about trying to find those higher margin products. Does that mean you lean more into the luxury brands that you work with as opposed to some of the cheaper products?
Actually, for most of our customers on the luxury side, they're mainly European customers. So most of the product do ship to Europe. Which is kind of outside this U.S.-China, say, tariff. But more importantly, again, our production, we just want to shift it from a place where, if there's a high Chinese-U.S. tariff, to a production base where there is no tariff to the U.S. or a much lower tariff. And that will might help our customer kind of solve that problem as well. And we're always looking for new places to expand to as well. I think there's always geopolitical risk, tariff, friction. What you really want to do as a manufacturer is diversify your production base as much as possible, so it gives your customer a way to low balance on these kind of issues.
I have a question about the Europe story then, because we kind of see right now there's that pressure coming down to car companies in China to diversify their production bases to Europe. Would you also look at Europe as being a basis for production there?
We have actually. In fact, we think from the footwear, handbag, accessory perspective, Italian makers are the best. Okay, there's no doubt in terms of quality, and we've always actually looked at places to expand our manufacturing in that area as well. So we'll continue to look. I think if the opportunity exists, we'll definitely do something there.
Let's bring up that full-screen graphic in using television jargon there to see the different customers that you have. As a preface to my next question, essentially, from my understanding, especially for Americans, when they've set up the OEM factory networks here, they really do put a lot of pressure on the manufacturers to squeeze their margin and basically shave costs. So there is not an inflationary side to it. But what are you hearing from your customers, as you see on the screen here, as far as their ability to raise prices?
For our customers, we are great partners for a customer. We're in long-term business with them, very strategic. So what we always do is work with them on how to get around product design to lower costs if there's necessary to potentially increase cost from the tariff position. So I think design, product development, re-engineering is a big part. Okay, but second is really, again, helping them, giving them production for goods that are shipped to U.S. in basis low tariff. If there are goods that are shipped to Europe, of course, all these brands are global brands anyways, we'll manufacture them in China instead. So we'll help them get around that issue, actually.
Chris, how inflationary is this going to be? Any final thoughts you have?
Okay, so if you look at the U.S. CPI data, starting from 2017 to now, actually, if you can find out that during the year of 2018-2019, actually the upward trend of CPI is not very significant in reality, right? So that actually provides a little bit of proof to our thoughts that if you decided to pass on the entire tariff pressure to the customers, maybe that will not be the 100% portion. Maybe you cannot finally avoid adding price, but brand operators would definitely try other ways to optimize cost structure first, right? So this way also includes actually expanding product mix, actually includes saving from other areas of the the cost base like logistics, warehouse. These are all the capabilities that brand customer has been developing. And also for OEM, apart from that, making their entire cost structure more efficient by diversifying product base, and every manufacturer are also developing automation capability, which could also help boost productivity. Yeah.